Hi, this is Jim Cunningham. Today we're going to talk about, can income smoothing lower your taxes? What on earth am I talking about? What is income smoothing? No one's ever talked about this. Well, income smoothing is the art of tax bracket arbitrage to keep your taxable income below the highest tax brackets. Okay. It's also about deferring income tax. You know, if you can pay that tax 5 years from now or 3 years or 1 year from now, that's better than paying it today for a lot of reasons that we'll talk about. So income smoothing strategies can build over time. They can save you money over time. This is a habit. It's not an event, and it is income smoothing. I'm Jim Cunningham. I'm a partner at Cunningham Legal, and we have offices throughout the state of California. I'm securities and insurance licensed and a certified specialist in estate planning, trust and probate law, a real estate broker, and a pilot. These are the lawyers in our firm. We really focus on essentially affluent families and making sure to minimize their taxes, income taxes, death taxes, capital gains taxes. If you are watching this on YouTube, please subscribe. Please also click the little bell. You will be alerted when we have new content being released, which is typically weekly on our YouTube page. Disclaimer, I'm a lawyer. I'm talking. This is just information, folks. Don't look at this and go, hey, I saw Jim do this, so I'm going to go out and do this and think this is legal advice. Bad idea. This is information only. Well, let's start with the United States tax system. So we need to have there's a little bit of foundational knowledge we have to get through. I characterize what we're talking about here as the confiscatory taxes. Now, what this means is you earn money in a year, typically a calendar year. If you're an individual, right? You earn money in a calendar year and the government says you cannot keep it all. You're going to have to give some to the government. That is, by definition, confiscation. It's not all your money. If you make $1 million a year, you are not keeping $1 million a year because some of that money has to go to Uncle Sam and here in California, I guess, Uncle Gavin. There are taxes on the federal level, as I mentioned, the state level, also local taxes. And in California, a real big tax for us is property tax. So we'll talk about ways a little bit on the property tax, but we do cover that in other webinars. The Fed by far collects the most income tax, and the big ones are income tax, sales tax, and property taxes. Those are going to be your state as well. And your income tax is based on two things. Number one, the amount of your income. Shocker, right? The more you make, the more you pay. So it's a graduated tax system. We'll talk about that. Also, your filing status. Are you filing single? Are you married filing jointly? Are you an entity, right? How your filing status affects the amount of tax that you pay. And I would say taxes largely target the rich. And the more you make, the more you pay. The more wealth you create during your lifetime, the more you're subject to taxation at death. If you don't make any money, there's no money to pay tax. Most of the taxes do come from wealthier people. It is a complex system, but by learning, hopefully you can minimize some of these taxes. So we have a graduated income tax system. What does that mean? Well, it's very important. And this might be Captain Obvious stuff, but it's very important. There's a concept called worst first. So if you're in a 37% tax bracket and you can get a deduction of $10,000, that means you pay $3,700 less in taxes. It doesn't mean you pay $1,000 less in tax rather than the 10%. So it's that those deductions come off the top. So they're very powerful. They reduce your income. And as you can see here, there's a sort of a pyramid structure of the 37% tax bracket kicking in, on income over 500 if you're single, and right about 700 if you're married filing jointly. This does exclude California income tax and other state income taxes, and potentially, municipal income tax like New York City. The income tax brackets, they're sort of numbers we throw around here. Net investment income tax, if you have income and then you have investment income and your total income's over 250, you're going to have to pay another 3.8%. So stated another way, if you earn $200,000 a year and you have $50,000 in investment income, you're not subject to net investment income tax. But as you'll see, if you have a minimum distribution that comes out of your IRA that pushes your income over 250, so you are subject to an additional 3.8% net investment income tax. So it catches a lot of people unawares. And the 37% rate, which is going to go to 39.6 in 2026, by the way, when the 2017 Tax Act expires. So these are high numbers. Again, this does not really even talk about state income tax. Capital gains tax rates, there are zero on a certain level of income. And so it's really important to manage. If you have a significant capital gain event, and you can't do a tax deferred exchange if it's real estate or something else, and you realize this capital gain, there is a tremendous benefit in looking at, not necessarily doing, but looking at strategies to spread that gain out over a period of years, because what you end up with is more money in your pocket, less going to the government. Again, we're a confiscatory system. There are social taxes, Social Security, Medicare. That is a social tax in the sense that you pay into Medicare and you get Medicare back. You pay into Social Security, you get it back. When you pay your federal income tax, nothing's coming back. It's gone. That money is confiscated. It's forever gone. It is never coming back to you. Yes, you do get services through the government, but for those of you who are paying a lot of tax, the amount of tax you pay typically far exceeds the benefit you're getting from living in the United States. So capital gains tax brackets, looking at another way, if you're a single filer, if you have a capital gain of $20,000, there may be no tax, right? That's kind of cool. So really, this is the art when we talk about tax bracket arbitrage. What we're talking about is keeping the money, keeping the income out of the higher brackets, keeping it out of the 20% tax bracket, and maybe getting it into the lower tax brackets over time. I would say before we even get there, in terms of we are going to get to income smoothing and talking about taxes, I would say there's some basic tax hygiene issues. Now, this is like, when you go to the bathroom, wash your hands. This is some basic stuff that I do personally and that we do for our clients. You typically want to harvest losses in high income years. If you've got some type of liquidity event, maybe you sell a property and you have some losers in your portfolio. And this really is an argument for perhaps owning individual stocks, frankly, because stocks do go up and they do go down. It just happens. But you can sell those stocks at a loss and offset some of that gain. So that's really important to pay attention to. It's also, if you have more than one financial advisor, I will tell you one of the sort of problems we see in the real world is if you have your money in like with three different advisors, first of all, you're probably paying more fees. Just bear in mind, because you do get break points the more you have with an advisor. But if you have three advisors and one advisor says, oh yeah, we're going to sell, I don't know, Apple's a bad example because it's up, but we're going to sell Apple at a loss. Okay, let's just say you're going to sell Apple at a loss. You may have another advisor say, hey, you should buy Apple because it's down, right? And if that happens within 30 days, then you're going to be subject to the wash sale rules, right? So if it's a transaction that occurs less than 31 days, a buy and a sell, you don't get the benefit of tax loss harvesting. So I would say a little bit of a hack in terms of tax efficiency is make sure you either go with one advisor, or if you have multiple advisors, they're talking. Hint, they typically don't like to talk to each other, kind of competitive crowd. You can contribute to traditional IRAs in high income years and get that deduction. And when you're in a lower income tax bracket, can contribute to Roth IRAs. We do cover this on another webinar. If you do not itemize your deductions, then it might make sense to do one or the other. And then consider tax deferred annuity. And I'm not selling annuities. All I'm suggesting is, and we do have an example in here, is sometimes you can take your investment and it can be put into an annuity platform that defers the tax. I don't see a lot of clients doing this. And I'm not out here selling annuities, but it is something to be mindful of, that annuities and life insurance are sort of tax deferred and tax free zones. And that's something that some people do, not often, but is something to consider. And different types of charitable remainder trusts, we'll talk about that. And installment sales, we'll cover installment sales. Installment sales, monetized installment sales are on the IRS's Dirty Dozen list. This is not a monetized installment sale. It's a legitimate installment sale. And life insurance strategies where maybe you overfund a life policy and you have a high cash value and borrow against it. We'll talk about that. Roth IRA conversions, and then and the importance of creating or keeping updated your family trust. If you realize a gain on investment, you're going to want to kind of comb through all your holdings to see if you have a loss. I mean, this is kind of basic. If your financial advisor is not doing this, they may not be doing their job. It's something really to pay attention to. Certainly, if you have individual stocks, we're talking about outside of your IRA, not inside your IRA. And again, we did mention the wash sale rules. You got to wait 31 days. So types of tax and methods to reduce tax. So we're going to talk about a lot of different taxes. We're going to talk about income, capital gains, talk about death tax. And when I say death tax, I'm not using that in the political sense, because that, everything's political in our country, always has been. That's a federal estate tax, as well as state death tax and state inheritance tax. So some states, Maryland has both a state death tax and a state inheritance tax. And the two that are kind of sleepers that kind of sneak up on people, at least on the West Coast, are Oregon and Washington. So Oregon's death taxes kick in on amounts over $1 million. In Washington, it's a little bit over $2 million. And Washington is 20%, and Oregon is up to 16%. So these are very important little, before you move, you might want to check in with your advisors, certainly check in with your estate planning attorney if it's an issue for you. And we'll cover a little bit of property tax. So there's tax exempt income. This is no tax at all. This would be municipal bonds, health savings account. It's not really needle moving in that sense. It's just really not that big. It's something you can do year over year. Social Security is income tax free in California. Not federally, but it's tax free of California state income tax and your Roth IRA. So a tax credit. So there's tax exempt income. You don't pay tax on that income. There's tax credit. So typically an investment tax credit. We'll be talking about that. That means if you get a tax credit, that reduces your tax liability. If your tax liability is $100,000 and you have a $10,000 tax credit, that reduces your tax by $10,000. So you only pay $90,000. A tax deduction, remember that $10,000 tax deduction, that is a $3,700 tax benefit at the marginal rate. So it reduces your top line income. And tax deferral strategies, we see that with an IRA, 401k, and annuities. So I would suggest that if you're and we'll give some age examples here, but that's something to consider. Depreciation, this is, you see this a lot with real estate. People who invest in real estate get depreciation that often offsets the net income, if there is any net income, and it can be a tax-advantaged investment. Basis management, this is if a spouse passes away, you really want to pay attention to titling of assets. You want to make sure your trust is funded. That gets you an adjusted cost basis on the death of a spouse in a community property state. Very important to understand that when one spouse dies, there is work to do, and there is a tremendous benefit because it can eliminate a significant amount of capital gain if the surviving spouse wants to sell assets, which many times does happen. And then the arbitrage. So this is tax bracket management, and can you swap income for capital gains? Can you get some type of depletion allowance? We'll talk about that with oil and gas. So let's cover some income smoothing strategies. So what do I mean by income smoothing? Well, what this means is if you can control the amount of income you have, maybe you have a business, maybe you say, well, I'll sell this property or this portfolio or exercise these stock options in a different year other than now. This is kind of what we're talking about. Then there are other things you can do with your investments. So this is like if you don't have any control over pulling the trigger, there are some strategies that are frankly kind of complicated and others that aren't. We're going to cover kind of a variety of them. But I would say if you look at income smoothing, this means to get your income into those lower tax brackets over time. Can be a tremendous benefit because again, when the government takes it, it's a confiscatory tax system. It's gone. Going from a 24% tax bracket to a 37% tax bracket is about an increase of 50% in your tax, right? So 24 to 37, you say, well, it's only 13, but half of 24 is 12. You see where I'm going with this. So it's like a 50% increase in your taxes if you can't keep it in that lower tax bracket. Increase your income in low income producing years and fill up the lower tax brackets is kind of the idea. This happens a lot of times in when people separate from their job, or maybe they have an early retirement. You retire at 60. That when you're in your 60s might be a great time to look at Roth conversions and other strategies, and we'll talk about that. So the idea is you want to fill up your brackets here. So we got some tax brackets here. A Roth conversion, I would say if you have an IRA, what a Roth conversion is you take your IRA, let's say you have an IRA with $1 million in it, and you convert that to a Roth IRA, you're going to pay tax on that $1 million. You're subject to tax. You cannot pay it from your IRA. You have to have other assets outside the IRA, or you have to do something to reduce your overall tax bill. So we do this a lot with clients when they look at a Roth conversion. We look at their other assets and we say, well, if you put these assets in that bucket, you're going to get a tax benefit that can help to offset the tax associated with a Roth conversion. So these all kind of work together. This is, I want you to think about your age. How old are you? How old do you think you're going to live? When are you going to retire? How much money do you need in retirement? And I would really encourage you to think about this in that time span. So now until maybe, the end of your life, what are your financial needs? This is kind of why people do financial planning. But, if you're maybe in your 50s and you're thinking about retirement, you're going to think, well, when's a good time to retire? If I retire at 62, I'll still have energy and I can do stuff, but will I have enough money, right, to live? And you might be able to retire sooner if you adopt some of these tax strategies, right, to pay less tax, because that means you have more because less is going to the government. So Roth conversions, and I would say if you also need to look at assets inside your IRAs and outside your IRAs, meaning if you have inside your investments inside of your IRA, you may take a different investment approach with investments inside your IRA than outside of your IRA, because everything that comes out of that IRA is subject to income tax. So it's something to work on with your financial advisor. Okay, so let's talk about if you're 25 to 45, or maybe you have kids who are 25 to 45, or maybe you wish you were 25 to 45. Here's kind of these are kind of general good ideas, right? You want to maximize your retirement. You want to maximize your 401k and your IRA. If you're working and you're 25 to 45 and you are not contributing to your 401k, if you have one at work, you likely have a match, right? So in our firm, we have a match. If you put $1 in, we're going to match you up to a certain point. It is basically free money. If you are not doing this, you are leaving money on the table. And I really encourage you, if you're younger or if you have kids who are maybe employed and they can contribute to a 401k, nudge them, right? Suggest to them it's a good idea to contribute to your 401k, because that reduces your tax liability. So it's not subject to income tax when you put that 8% of your income in there. You're not paying income tax on that 8%. So it's a tax savings. And if you do not itemize your deductions, it's gonna change the nature of it, but it's a good idea on a high level. Now, I would think about some Roth or Roth 401k. Now, you do not get the income tax deduction, but in your case, it may matter, it may not matter. It just depends. Tax deferral potentially via annuities. Now, annuities tend to be a more secured, more expensive investment, if you will, but they tend to be more predictable. Some people feel better if it's more predictable, but consider that. The idea of an annuity versus outside is you are deferring the tax on that annuity. So you're avoiding paying that tax on that investment return. Especially true now that we have a higher interest rate environment. When you can now get 4 or 5% on a CD, it's really important to pay attention to your income, right? So if it's in a tax deferred vehicle, you're not going to be paying tax on that, maybe 5% income. Low risk oil and gas transactions. We'll talk a little bit about oil and gas. That is a way to get a current income tax deduction. It's fundamentally a deferral and a slight tax reduction strategy in the amount of tax you pay. And I would say low risk real estate transactions, again, low risk, not house flipping, but maybe a REIT, maybe that's a real estate investment trust that can have some tax benefit. Maybe you buy a rental, right? And maybe you become a landlord, maybe you have a rental or two. And so 46 to retirement. So this is kind of where it heats up, and I'm 54. So I'm really thinking, I'm right in the middle of this age bracket, right? I would say you're going to continue doing what you did when you were younger. Really look at your retirement plan. This is really one you juice up your retirement plan. Sometimes these are the highest income earning years for people, and you can look at deferred compensation. So if you're working and you own your company, look at deferred comp. Right? That's a possibility. So that defers that compensation if you're, a key person in an organization. And then aggressively manage taxation of wage earnings. This is very, very important. Higher wages, higher income tax bracket, and really look at your taxation of your investments. And I will tell you, when last year, a lot of people who owned mutual funds, the mutual fund went down in value, and they were stuck with the tax bill. How does that happen? When the mutual fund goes down in value, the mutual fund company, people want their money back out of it. They have to sell stocks to give the people their money, right? When they say, I'm going to sell my shares in this fund. And they may have to realize a gain because we had all those gains, right? So the actual value of the mutual fund can go down in some cases, and you're stuck with the tax bill, which is crazy. And a lot of people don't understand that. So I would say the larger your holdings are, the more I would, I'm not sure mutual funds are a great investment. Well, first of all, they're not for everyone, but if you have a really large portfolio, a mutual fund may not be as tax efficient as you might need. And then at retirement, consider rollover of pensions and profit sharing plans to an IRA. This is so that, because when you first of all, you don't want to leave your money with the employer. The employer can actually borrow against that. And a lot of people don't know that. So you definitely want to take that IRA with you when you separate from the company, roll that over. You do lose some creditor protection. 401ks are protected from creditors, but your investment options many times are severely limited with a 401k. And certainly when you pass away, there are more tax advantaged planning strategies if you have an IRA versus a 401k. Consider asset protection issues, protecting your assets in retirement. Certainly if you have finished a career and maybe you might have some lingering personal liability, you're going to want to take a look at that. And net unrealized appreciation. This has to do with company stock and a 401k, kind of granular. I just mentioned it. If that's you, really pay attention to that. That's an opportunity. And then the 10% early penalty. If you're under 59 and a half, there's an election you can do if you retire before 59 and a half and you need to take money out of your IRA to live on. And then manage basis on IRAs and qualified plans and your qualified Roth distribution. So really pay attention to those IRA accounts. And I would say should you take, if you don't have any income and you're 60, let's say, and you've retired, maybe you should take out of your IRA, right? If you have absolutely no income because it's coming out at a 10 and a 12% tax bracket, right? That may make sense. If you're not working, if you're not doing a Roth conversion, you may want to take that money out. And because you're paying it at a significantly lower rate, it also reduces your minimum distributions when you hit your required minimum distribution period. So kind of important. That's kind of meeting with the financial advisor and the CPA. We talk about an A team in our firm here, where you have the CPA, financial advisor, and lawyer. But really pay attention to that. Those tax brackets in retirement, because early retirement can be a great tax planning opportunity. If you're over 22%, it's kind of the break point. You got some California income tax in there potentially, but you probably don't want to go over that 22% tax bracket. And then you would take outside non-qualified assets and deferred compensation first to live on. So if you can think you've got your assets stacked up, you retire at 60, you might have some savings, you might have some deferred comp, you might have some stock that's outside of your IRA. You probably wouldn't want to be taking IRA distributions that push you up into a 37% tax bracket when you can sell other assets and pay less tax. So stated another way is, don't just blindly assume that you're retired and you're 60 and take money out of the retirement account because it's easy. You're also paying tax on that. So really pay attention to this. And this is something you can look at with your A team, your CPA, your financial advisor, and your lawyer as well. And so there's sort of a hierarchy and an ordering. In late retirement, you're going to be subject to RMDs, required minimum distributions. And I would say spend down high basis assets. What do I mean by that? Well, let's say you have a home that's depreciated, right? You buy it for $100,000, it's worth $1 million, it has no basis, or a very low basis. So if you sell it, you pay a lot of capital gains tax. You have $1 million in savings, right? It makes sense to live off that $1 million in savings rather than sell the house and live off the proceeds from the house, because you're gonna have to pay $350,000 in capital gains tax, right? When you die, if it is included in your estate, it's a big if it is included in your estate, much of the time those assets are, then your heirs get an adjusted cost basis and that capital gains tax bill goes away. So it's very important to pay attention to basis, very important to reach out to the advisors, and don't, I wouldn't let emotions take over, but you really have to take like a rational approach to this. And then you can then, so the sequence is non-retirement assets, and then RMDs. If you need more than the RMD and you don't have any other assets, then you're taken out of the retirement account. And then make sure your estate plan's updated as well. So let's look at an example here with Hal. Hal owes $100,000 in tax because Hal did no planning. But if Hal did good planning, the same $100,000 in taxes owed is deferred for 15 years, and the net present value of $100,000 in 15 years is $41,000. Meaning, if he defers that tax for 15 years, that tax is not $100,000; it's $41,000, because he's paying it over a period of time. So with effective tax bracket management, you can accomplish this. All right. You're deferring that over time and probably paying it maybe paying it a lower rate as well. Right. And then also with the net investment income tax. And again, that's that extra 3.8% tax on amounts over $250,000. There's some ways to manage that, but you really have to pay attention to this. And, a lot of times people come to us and they say, hey, I've signed an offer to sell my company. Great. It would have been nice if you could have come in earlier, because we might have been able to do some more planning strategies. Or somebody says, hey, I sold my house. how do I do capital gains tax planning? Well, I sold my house and I got the check. It may be too late. So really you want to talk to your advisors a little bit earlier in the process. So let's talk about retirement income smoothing strategies. All right. Pretty complicated, kind of a hot mess, can be a hot mess, charitable trust. But I do want to talk to you about the concept of a charitable trust. You can sell something, and we do have an example here, or maybe we don't. So here's the idea. Instead of you have $1 million house, instead of selling that house and paying $350,000 in capital gains tax, you transfer the house to a charitable trust. Now, one type of trust here's what a charitable trust is. It's kind of a tax-free or tax-deferred zone. When you sell the house, no taxes due. You, who have contributed this house to this charitable trust, the way this example is, you get an income stream coming back. Maybe it's 5%, maybe it's 7%, maybe it's 12%, whatever. It's depending on your age, depending on interest rates, and depending on how much you want back. This can be purely a tax deferral strategy. A charity need only receive 10%. So a charity only gets the least it can get is 10%, meaning you can contribute something to a charitable trust and you can defer taxes for, depending on how it's written, a very long time, or maybe nothing comes out, right? For a very long time, and then it just grows and grows and grows. And then at one point it does come back. And when it comes back to you, it's taxable to you as income. So very important to understand the charitable trust. The idea is you transfer property to a trust and you get payments back yearly, monthly, quarterly, whatever it is. And then at the end of the term of that trust, a lot of times it's when people die, that asset, whatever's in that trust, goes to charity. So sometimes people take some of that money that's coming out and they buy life insurance to replace the asset that's going to charity. But a charitable remainder trust is fundamentally for this example, a tax deferral strategy, not so much a tax saving strategy. Roth IRA conversions, this is purely kind of a math function. Is with the Roth IRA conversion, a lot of people are reticent to do it. They say, I have $1 million IRA. I'm just using $1 million as a number. $1 million IRA. Why would I want to pay tax on that? Well, you might be able to do some other strategies that we'll talk about to reduce your tax bill, but you also have to have money outside of that IRA to pay the tax. What you do is you run the numbers. That $1 million IRA may be $2 million. Your minimum distributions might be $50,000, $60,000, $70,000 a year on that when you start your minimum distributions. That may push your income up to where you have net investment income tax, which is an additional 3.8%, right? So these are the factors we look at in working with financial advisors, because we do like to work with certified financial advisors on this, because when you do a Roth IRA conversion, you may be doing a little bit this year, a little bit next year, as you fill up maybe to that 22% tax bracket, you might be doing this in a year where you're not working, where you don't have earned income, and you're not receiving Social Security. And you see where I'm going with this. So there is kind of this Goldilocks sweet spot for a Roth conversion. It is not for everyone. I will say, if you have a large estate, if you're single and you have an estate over 10 million, or married and have an estate over 20 million, and you have IRAs, the full value of the IRA is included in your estate, even though half of that is going to go in tax. So stated another way, about 90% of that IRA is ultimately subject to tax at some point. So it might be better from an estate tax standpoint, right? If you have a high net worth, to do the Roth conversion, pay the tax, because it's less tax for your family overall. And again, this is something you can model out on a spreadsheet or other software. So let's look at the Roth IRA conversion. Tom filing single has salary income of $100,000 and dividend income of $100,000. So we have Tom here. He is not subject to net investment income tax, even though he has $100,000 in net investment income, right? Because his modified adjusted gross income does not exceed his applicable threshold amount, which is $200,000. So because he doesn't earn more than $200,000 a year, not subject to net investment income tax. But when he takes 75% from his IRA, now it's $275,000 his income, and he's subjecting 75% of that income to net investment income tax, which comes in at $2,850. Now that's an example. If this were a Roth IRA, he would not be paying that $2,850. Now $2,850 doesn't sound like a whole lot of money, but $2,850 for 20 years, it starts adding up, right? It starts being significant, and money's money. So when should you convert to a traditional IRA to a Roth? Really, if your income is up to 182 if you're single and 364 if you're married, it might make sense to look at a Roth conversion. So beyond that, it may make sense. It might not. So this is why I'm suggesting a lot of people, when they retire and they don't have much earned income, or they don't have any, and you're married, you might want to, do a Roth conversion, maybe 364,000. And that moves it from the taxable bucket to the tax-free bucket in the Roth conversion, rather than just leaving it in there. Okay. Because if you leave it in there, you're going to pay tax on that anyway. You're going to pay it. Your kids are going to pay it. It's going to get paid one day. And again, this is a math puzzle that your certified financial planner can help you with. Income smoothing strategies, tax credits, oil and gas, tax deferral. Oil and gas investments. We do talk a lot about solar in our firm and oil and gas, which sounds a little kind of, crazy, because one's renewable, one's the opposite of renewable. But you need to understand, the United States government for the last 100 years has followed a cheap oil policy. Okay, so the United States government subsidizes the development of oil and gas domestically in the United States. It's just a fact. It's the way it is. You can agree with it. You can disagree with it. Both Republican and Democrat are behind this. This is not something that really is subject to political whims. I think pipelines are a little bit different. But what we're talking about here is we're talking about drilling a hole in the ground and pumping oil out, right? And putting it out to market. So what is going on here? So if you invest $100,000 into oil and gas, you can take a deduction of $100,000. Well, let's look at this Sam example. Sam earns $100,000 in 2023 and sells $500,000 in stock with the basis of 100, causing a long-term capital gain of 400, right? So his tax bill is 71,000. And his blended rate is 17.9%, right? Because your capital gains tax rate, you've got, this kicks him into net investment income tax, right? So he's going to pay 71,000 in tax. If he puts 375,000 into oil and gas partnership. Now, remember, Sam makes 100, sells 500,000 in stock with a $400,000 gain. Sam puts 375. So he puts maybe some of that proceeds of the stock in an oil and gas partnership. He gets $50,000 a year annual income. So he gets $300,000 back. And you're saying, wait a minute, if you put 375 in and you get 300 back, wait a minute, what's going on? In the year that he makes the investment, assuming an 80% deduction for intangible drilling costs, this is drilling the well, the concrete, the casing, all that stuff. He can deduct that. And that's deductible for federal and state. So you put 375 and he gets a $300,000 deduction. This eliminates all of his $100,000 ordinary income at 22%, 12, and 10, and then reduces his capital gain. Sam had 500,000 in taxable income, but now 200,000 is taxable. 41,000 is at a zero rate. 158,000 is at 15. And so we're going to recap the numbers here. Before oil and gas, he was paying 86,000 in tax. After oil and gas, he's paying 23. He saved 62,000. Right? That's why people do it. And you get these payments back. You have a depletion allowance that cuts the taxable income. As it comes back, you're getting basically a 15% discount on your income tax. So this is a strategy that a lot of our clients will do 100,000 a year, every year, year over year over year. When that income comes back, it is taxable as income, but then we do something else the following year. So we're doing this in multi-year tranches, right? So historically, prior to 1980, this is kind of a trick. And, we had the 1982 Tax Act and again in 86, it kind of changed a lot of stuff. So, so you used to be able to do something really kind of cool. If you had undeveloped land with $100,000 basis and a fair market value of $1 million, the parent would sell the property and take a 10-year installment note back, right? So they'd sell the property to a trust for the kid's benefit and take back a 10-year note. And the child gets the basis of $1 million and the parents are getting $100,000 a year for 10 years. And so they spread that income out over 10 years. And then the trust receives $1 million in cash to pay the parents. They turn around, the trust turns around right away and sells the property. So parent sets up a trust, parent transfers low basis property to the trust then sells the property. And then the trust pays $100,000 a year back to the parents. The government got completely shut this down. And so you can't do that, but shut that one down. But there is another strategy. If the trust holds a property for 2 years, this rule does not apply. So, you know, this is an interesting, this is going to be used typically if people have kids, wealthier families. This is if you want to, if you can sit on some property for a couple of years, you know you're going to sell it, and you just can't make a deal in that 2-year time period. You really can't have any structure in there that where you have a deal. And so the idea is you still set up this trust, you then sell the property to this trust, take back an installment note. And if you wait 2 years to sell it, you can still do this. Not many clients do this, but some do. This can be a very powerful strategy to defer the tax. So the parents own Red Acre with a basis of 500. So parents own Red Acre, piece of property, basis of 500 and a fair market value of $1 million. They sell it to a trust and take back a 10-year note, 10 years of payments for 100,000 plus adequate interest. You got to put interest on that. And the trust's basis in Green Acre or Red Acre is the amount of the note, which is $1 million. And after 2 payments, the trust sells the property to a third party for $1 million. There's no gain because the trust basis is equal to the selling price. And it's really, you got some time value of money going on here. This is kind of tough because people say, well, I don't know what the market's going to be in 2 years. So it can be a little tough. So you cannot, if you're doing this 2-year installment note, you can't have a deal set up kind of on the side. You can't, and that kind of blows your 2-year statute or your 2-year time period, baking period. Non-qualified tax-deferred annuity. What is this? A non-qualified tax-deferred annuity is a contract. So fundamentally, a contract, if you have an annuity and it says this annuity is tied to the S&P 500, the insurance company, it says, I will contractually pay you an amount based on if it rains on Wednesday or what the S&P 500 does or some percentage participation. There's all these different formula out there, right? The insurance company isn't necessarily investing the money in the S&P 500. They're doing other things with the money, okay? So they're just using this standard as a metric for a return. Something to understand on a non-qualified tax-deferred annuity, any gain, right? Any gain. So if you put $1 million into it and it goes up to $1.5 million, that is taxable as ordinary income, okay? But these can be good tax planning strategies. And we have a really interesting example here. So what we've got is we have Hank, who's single and 50. Now, Hank earns $650,000 a year and he has $1 million in bonds, right? That produce $50,000 a year of annual taxable interest income. Maybe they're corporate bonds, right? So he's got a salary of $650. He's got investment income of $50. So his total income $700,000. And he expects to kind of have the same income for the next 15 years. Hank is pretty sure he's going to retire at 65 and doesn't need, this is really key, does not need the $50,000 income, just kind of going on the pile. When Hank retires, he's got $150,000 of Roth IRA income and the bond portfolio income. And Hank has a couple of options here. So he'll have $200,000 a year in income. Hank does nothing, and the 50% of interest income is taxed at the 37% rate plus the 3.8% net investment income tax, or 40.8%. That's $20,000 a year and $5,800 in California income tax. So that's for the next 15 years, a lot of money. When Hank retires, the Roth money's not taxable, but the $50,000 is entirely taxable as income. And Hank is not subject to net investment income tax at that time. His tax bill will be $6,300 and his state income tax bill will be $1,300. So not a whole lot. Now, Hank puts $1 million bond portfolio in a vehicle that is a fixed deferred annuity. Again, I'm not selling annuities. I'm just walking you through a concept. At 65, the $1 million buys an annual annuity of $75,000. Now, this is a tax-deferred investment. This saves Hank $26,000 in taxes every year for the next 15 years. That's $280,000 less in tax that he paid, right? Because maybe that's a lot of vacations. He retires and has $225,000 in income. He's got $75,000 from the annuity and $150,000 from the Roth, and no net investment income tax. And his income taxes are $3,200 a year. Okay, so what happens here is when you put money into that IRA, that million maybe grows to $1.5 million. When he starts drawing down on that annuity, 2/3 of that is return of his principal. That's not taxable. And 1/3 is taxable. It's not all taxable coming out at once if he annuitizes the annuity. I know I'm throwing a lot at you, but understand if you've got investments that are kicking off a fair amount of income and you're paying income tax on that every year, there are some strategies that you can do to put those in a different vehicle. So you have to figure out net present value, which apparently that's a formula. I have no idea what it says, but you really need, this is the balancing act. This is why you should work with a certified financial planner, someone who's really good at math, because this is fundamentally a math problem. It's got to be right for you. It may be right for you. It may not be right for you. Permanent life insurance is an income tax-free zone. We like to call income tax-free, not death tax-free. We're not talking about modified endowment contracts. That's if your cash value gets too big. But what we're talking about here is somebody has a life insurance policy and they put, and again, I'm not selling insurance. I'm just telling you what some strategies are. Life insurance can have a cash value. So a term policy, you have it for 10 years, you pay $1,000 a year. If you die, your family gets money. If they don't die, they don't get money. With a permanent policy, it has a cash value. It is designed to be permanent for the remainder of your lifetime. And if your policy, maybe you put $500,000 in premium payments, and you have a cash value of $600,000, let's say, over time, you can take that money out by borrowing it, and that is not taxable. Okay, so what you're doing is you're borrowing the cash value back, and your interest on the loan does accrue. But it is a strategy, right? And this, again, is an after-tax strategy. If you live in Texas, probably doesn't look as attractive as if you live in California, right? Because we have state income tax. So if you live in a tax-free state where there's no state income tax, this might look not as appealing, but certainly in the higher income tax states, that's going to be more attractive. There is something called private placement life insurance. If you're selling a business, a company, and you have big liquidity event, I would say the break even on that, 10, 20 million, something like that. Private placement life insurance is where you essentially put the company inside of the life insurance policy and then sell the company. And then there's no income tax because it's a life policy. So kind of a little bit outside of the scope of what we're talking about here, but just know that private placement life insurance is a thing and it's for significantly larger transactions. Let's talk about solar credits, commercial solar. So income smoothing strategies, tax credits. So commercial solar is great. So we had something called the Inflation Reduction Act, which is kind of, I don't know, humorous, where the government spends at $1.5 trillion on building infrastructure, and somehow that's supposed to reduce inflation. Anyway. So here's the good news, folks. If you are a high income earner or a wealthy person, if you are subject to a lot of tax, the federal government has taken the big truck and filled it with $1.5 trillion in money, and they're handing it out to people. So if you have a lot of money and you're rich and you pay a lot of tax and you don't want to pay tax, really you should be looking at commercial solar. I'm not saying you should do it. I think you should look at it. Now, here's how this works. A developer who's a builder, and in this case, developer means builder for these purposes, approaches a nonprofit, municipality, utility, or government, right? So why? Because they don't pay tax. A nonprofit, a municipality, utility, or government is not paying income tax because there's an income tax credit associated with this. So go with me on this. So the developer says, hey, we'd like to lease some space. We'd like to lease your roof. We'd like to put a solar array on there. And what we'll do, and it's maybe like a 3-year process, 2-year process. What we're going to do, Mr. Nonprofit or Ms. Municipality or utility or government agency, is you're going to buy the solar power from us, right? The developer says, you're going to buy the solar power from us for a 25-year period. And they say, great, I'm in PG&E. I'm paying 55 cents a kilowatt hour and I can pay 25 or whatever the agreement says. Great, they'll do it. And the numbers work for everyone. So this investor, this developer gets 95% complete. And then the shares of the LLC, right, that this developer's created are then sold, right, to a wealthy person typically, or a high income earning person. And that investor, because it's not complete, that investor gets the tax credit. Now, in most situations, many of our clients have what's called a 100-hour active participation requirement, meaning you have to spend 100 hours in the year you acquire the project to be learning about solar. There's a solar convention in Vegas in September. It's a 4-day event. That's going to take care of a lot of the 100 hours, right? You go visit the site, you read about it, you meet with your advisors, but you have to have material participation of 100 hours unless it's passive business income. And this is not like dividends from from Apple or C Corps or anything like that. If you have passive rental income or something like that, you can do this and not have the active participation requirement. So a dollar for dollar reduction in the tax due. So this is the investment tax credit. So if I put $1 in, I'm getting a benefit. I'm getting a tax credit that reduces my taxes dollar for dollar. And most of these are going to reduce, there are two variants on it. Many of these, you get about a 67% tax benefit up front. And some of them you might get 135% tax benefit, meaning you put in $800,000 and you extinguish $1 million tax liability. So you actually are getting effectively a discount on your taxes. Where's that money coming from? It is coming from the 1.5 trillion, right? From the Inflation Reduction Act. So the government can't build out renewable energy. The federal government is not going to hire federal contractors to put solar panels on top of a PG&E building, right? They're not going to do it. It's going to be individual people, right? This is kind of how America is built. It's individual initiative, and then wealthy people buy these projects. Solar's been around a long time. This investment tax credit has been around for a while. It used to be, before 2017, that these were picked up primarily by Fortune 500 and Fortune 1000 companies. When the tax, federal tax, corporate tax went from 35 to 21, it started to not make sense. And so that's why you see a lot more of these since about 2017. And it took a while for people to catch on. But it's a 30 to 70% investment tax credit. An example is a $10 million investment provides $6.4 million in tax benefit, meaning reduces taxes by $6.4 million. So your net investment's $3.6 million. Cash flow is $500,000 a year for 25 years. So you're going to turn $3.6 million into $8.2. I just took that on a net present value. Not a bad deal, right? So not only are you saving tax, but you're ahead of the game with commercial solar. And then here is a solar project. This is happens to be in Massachusetts. So the idea here is you put in 770 and you get 928,000 back in tax benefit. Years 1 through 6, you put 770 in, you extinguish $1,086,000 in tax liability. This is one example. There are many like this. This happens to be a flip structure, which we can talk about, but there are two ways to do this. One is you can buy the underlying project, or the other one is you can be in a partnership and own 95% of it. So that's something we can talk about one-on-one, but just know that your return is 141%, meaning you put in 770, you're extinguishing $928,000 in tax liability. So if you sit down with someone who doesn't understand this, an investment advisor would say, well, that 770, this isn't a good investment, whether it is or it isn't. But the fact that it extinguishes $928,000 in taxes, you're already ahead, right? So you're looking more at the after-tax effect and using this as a tax mitigation strategy. Cost segregation. For those of you who have real estate and don't know cost segregation, I really encourage you to take a look at this. Talk to your CPA about it. You can certainly talk to your tax attorney about it. The default is 39-year straight line depreciation for commercial real estate and 27.5-year for residential. This includes multifamily, meaning the government says, hey, if you have a commercial property in 39 years, that building's going to fall down and it's going to be worth zero. Kind of a, fantasy a little bit, because the building's probably still going to be there, but you do get a 1/39th of the value of the structure income tax deduction every year. So you can change the method of depreciation. And so you can compress this into essentially about a 7-year time period when you kind of factor everything in. And this is a very common strategy for people to accelerate the benefit, the tax benefits of owning property. And then after 7 years, you sell that property and do a 1031 exchange and get another property with a little bit of debt. So Wanda has Green Manor, a multifamily apartment with a value of $3.75 million. The land's valued at $1 million and the improvements are $2.75 million. Wanda gets $100,000 depreciation deduction annually. With cost segregation, it can be larger and frequently entirely offsets the entire net income from the property, resulting in a tax savings. So if she's got positive cash flow, maybe there's no debt. She's got positive cash flow. It's going to offset this and effectively make it tax-free. If she's a real estate investor, she can get a business. She can get a tax benefit beyond that. So if she's a real estate professional. That brings us to the end of our income smoothing strategies. I hope you have enjoyed it. We have more information on our YouTube channel about many of the things we've spoken about here. We have offices in Northern and Southern California. And if you would like to reach out to us, you just go to our website and schedule a free call, or call us at 866-988-3956. Please subscribe to our YouTube channel if you haven't already. Click the bell. You'll be alerted when we have new material, which is typically Thursday evening. And next week, July 27th, we have legacy life insurance policies. Is your coverage evolving with your needs? What am I talking about? I'm talking about permanent policy, like a permanent life insurance policy that you may not need anymore, right? Or you might still need it. You might be overpaying. If you bought it a long time ago, the cost of insurance has come down when compared to years and years ago. It's gone up a little bit during COVID, but the cost of life insurance has come down by and large. And we really encourage you to take a look at this if you own any kind of life insurance with a cash value. So if you're watching this on YouTube, keep watching, because we have a next video coming right up.